Markets can feel unpredictable, but understanding inherent patterns and key indicators offers valuable insights for making investment decisions.
Markets undoubtedly exhibit cyclical behavior.
Can you elaborate on those cycles for us?
One crucial concept is generational cycles lasting 16 to 18 years.
So these generational cycles basically represent extended market moods.
They are characterized by growth peaks, declines, and recoveries.
And I imagine within those larger cycles you're talking about, there are probably smaller cycles as well.
Within these larger cycles exist shorter 4-year cycles.
The shorter cycles probably sound a lot more familiar to most investors. What influences those shorter-term cycles?
These are primarily influenced by central bank actions and subsequent economic responses. Most investors experience these shorter cycles in their day-to-day trading activities.
Given these generational cycles, where are we in the market right now?
We are currently in a bull market nested within a larger generational cycle.
So we're in a bull market. When did this particular bull market begin?
This bull market commenced in the fourth quarter of 2022 and possesses the potential to extend into the 2030s.
Wow, a bull market stretching into the 2030s. What makes you so confident about that prediction?
This prediction is supported by technical analysis of price patterns, demographic trends such as millennials entering their prime spending years, and potential productivity gains also contribute to this bullish outlook.
Even within a bull market, there are certainly factors we need to be paying attention to.
It is essential to monitor key financial indicators.
These indicators act as a compass to guide our investment choices.
One such indicator is the 10-year Treasury yield.
If I remember correctly, when that yield goes above a certain level, it signals a warning sign for investors.
Historically, a yield exceeding 5% suggests a potential end to a bull market. The yield recently reached 5% before retreating. It is a metric demanding close attention.
What would you consider a normal range for the 10-year Treasury yield?
A normalized range for the 10-year Treasury yield typically falls between 3.25% and 3.50%.
Aside from interest rates, what are some other crucial indicators we need to be watching?
Another crucial indicator is the US dollar, specifically the DXY index.
And the DXY index reflects the dollar's strength against a basket of other currencies, right?
The dollar's strength is closely linked to interest rates.
So what kind of level on the DXY index should investors be watching out for?
If the DXY index surpasses 107, 108, it may indicate stress within the equity market.
Besides interest rates and the US dollar, are there any other indicators we should be watching? What about things like gold and cryptocurrency?
Gold often serves as a gauge of risk appetite and an inflation hedge.
Gold has been making some moves lately, hasn't it?
Following a period of sideways trading, gold entered a bull market.
So is gold still in a bull market?
It is currently undergoing a consolidation phase. Cryptocurrency, notorious for its volatility, acts as a proxy for risk appetite.
We've definitely seen some big moves in the crypto space over the past few years.
Recent surges in crypto-related equities suggest caution due to potential overvaluation.
So we've talked about all these indicators, but how do we actually apply this knowledge to our own investment decisions?
Recognizing the current market cycle phase is paramount. Different phases necessitate distinct strategies.
So what kind of approach should we be taking given that we're in the early stages of a bull market?
During a bull market's early stages, diversification is crucial while leaning towards growth in cyclical sectors.
And then as that bull market matures, what adjustments should we be thinking about making to our portfolios?
Incorporating defensive sectors such as consumer staples, healthcare, and utilities can provide balance and stability during a maturing bull market.
We've seen some pretty strong performance from small cap stocks recently. What are your thoughts on those?
Small caps, especially those within the S&P 600, offer growth potential. However, they may not consistently lead the market in later bull market stages. Exchange-traded funds, ETFs, focused on small caps, provide a diversified approach, mitigating risks associated with individual stock selection. You mentioned the current generational cycle's potential to extend into the 2030s.
You also mentioned a target for the S&P 500 reaching 14,000 by the mid-2030s.
Predictions inherently carry uncertainty.
Of course.
My projection for the S&P 500 reaching 14,000 is based on historical trends, technical analysis, and potential future growth drivers. Demographic trends, such as millennials entering their prime spending years, coupled with advancements in technology and innovation, contribute to this long-term bullish outlook. It is essential to acknowledge that unforeseen events and economic shifts can always influence the market's actual trajectory.
So while the long-term outlook looks pretty positive, there's still the potential for some bumps along the way.
Even within a bull market, acknowledging potential downsides is prudent. Historically, the second year of an election cycle often experiences a mid-year correction.
So we might see a dip in the market sometime next year.
Additionally, the third year of a bull market tends to exhibit weaker performance compared to the first 2 years, though it remains part of the overall bull market.
Those historical observations provide provide valuable insights into potential market behavior in the coming years. Now let's delve deeper into specific investment strategies tailored for different market environments. Considering the early stages of a bull market, characterized by heightened investor optimism and robust economic growth, what investment approach do you recommend?
During a bull market's nascent stages, a growth-oriented investment strategy is generally advisable. Prioritize sectors like technology, consumer discretionary, and industrials.
So we're talking about sectors that tend to benefit from economic expansion.
These sectors often benefit significantly from economic expansion and surging consumer demand. Within these sectors, focus on companies demonstrating strong earnings growth potential, innovative products or services, and a proven track record of execution.
Companies that are poised to really take advantage of those positive market conditions. Then, as the bull market progresses and transitions into a more mature phase, how should we adjust our investment approach?
As a bull market matures and economic growth moderates, shifting towards a balanced approach incorporating both growth and value stocks is prudent.
So not just chasing those high-growth companies anymore.
Consider sectors like financials, healthcare, and consumer staples where value stocks often reside. These stocks tend to be less volatile than their growth counterparts, offering a steadier income stream through dividends.
Adding a bit of stability to the portfolio. And as the bull market reaches its later stages, what further portfolio adjustments would you recommend?
In a bull market's later stages, increasing your allocation to defensive sectors such as consumer staples, healthcare, and utilities is generally wise.
So those are the sectors that tend to hold up better when the economy slows down.
These sectors are less susceptible to economic downturns, providing a buffer against market volatility. Their products and services are essential regardless of economic conditions, rendering their earnings and dividends more resilient.
They provide that stability and resilience during uncertain times. Of course, we've been talking about how to navigate the various phases of a bull market, but what about when things turn south and we enter a bear market?
During a bear market, capital preservation becomes paramount. One strategy is to increase your allocation to defensive sectors, as discussed earlier.
Those same sectors that provide stability in the later stages of a bull market.
Consumer staples, healthcare, and utilities tend to hold up better during economic downturns due to the essential nature of their offerings.
So building that defensive barrier for the portfolio, what are some other things investors can do to protect themselves during a bear market?
Another approach is increasing your cash position. A larger cash reserve provides flexibility, enabling you to capitalize on potential buying opportunities emerging as stock prices decline.
So you're ready to pounce when those opportunities arise. I imagine maintaining that long-term perspective during a bear market is challenging. It's easy to get caught up in the fear and make impulsive decisions.
Bear markets are an inherent part of the market cycle. They eventually give way to bull markets. Staying disciplined, adhering to your investment plan, and maintaining a long-term focus are crucial.
So don't let those emotions get the best of you. Are there any specific investment vehicles or strategies that can help investors mitigate losses or even potentially profit during a bear market?
Completely avoiding losses during a bear market is challenging. However, certain strategies can mitigate downside risk. One approach is investing in inverse ETFs, designed to move inversely to a particular index or asset class.
So if the market goes down, these inverse ETFs go up.
If the underlying index declines, the inverse ETF appreciates in value, offering a potential profit opportunity from market declines or a hedge against losses in your existing portfolio.
But I'm guessing those are more of a short-term tool.
However, inverse ETFs are generally considered short-term trading instruments, potentially unsuitable for long-term investors. Are there other alternative investment strategies to consider during a bear market?
What about things like gold or commodities?
Exploring alternative investments such as gold, commodities, or certain hedge fund strategies designed to perform well in volatile or declining markets is another avenue.
So diversifying beyond those traditional stocks and bonds.
This diversifies your portfolio beyond traditional stocks and bonds, seeking assets offering potential protection or positive returns during market downturns.
Speaking of diversification, that seems to be a recurring theme in our conversation today. Is that a principle that applies to all market environments?
Diversification is a key principle serving investors well in any market environment. It involves spreading your investments across different asset classes, sectors, and geographic regions.
It's about not putting all your eggs in one basket.
This reduces the risk of concentrating your portfolio in one area. If one asset class or sector underperforms, others can potentially offset those losses.
So how should investors approach building a diversified portfolio?
Building a diversified portfolio requires careful planning and consideration of your investment goals, risk tolerance, and time horizon.
It's not a one-size-fits-all approach.
Start by determining your asset allocation, the percentage of your portfolio allocated to different asset classes, such as stocks, bonds, real estate, and commodities.
And your asset allocation should be tailored to your specific situation.
Align your asset allocation with your investment goals and risk tolerance.
So a younger investor might have a different asset allocation than someone nearing retirement.
A younger investor with a longer time horizon might allocate a larger portion to stocks, seeking higher growth potential. A more conservative investor with a shorter time horizon might favor bonds, offering lower returns but also lower risk, providing stability as they approach retirement.
So once you've figured out that overall asset allocation, then what?
Once your overall asset allocation is established, diversify within each asset class. For instance, within stocks, diversify across different sectors, market capitalizations, and geographic regions.
Don't just invest in one or two stocks.
This mitigates the impact of a single investment underperforming. Diversify your bond holdings by investing in government bonds, corporate bonds, and municipal bonds. Government bonds, issued by governments, are generally considered low risk.
They're seen as a safer bet.
Corporate bonds, issued by companies, carry higher risk than government bonds but offer higher potential returns. Municipal bonds, issued by state and local governments, often offer tax advantages.
So there are different types of bonds to consider as well.
Including a mix of these bond types further diversifies your fixed income exposure.
It's all about spreading that risk around.
The key is to create a well-balanced portfolio aligned with your investment objectives and risk tolerance.
A portfolio that's built to weather those inevitable market storms. So we've covered a lot of ground today, from market cycles to diversification to risk management. Any final thoughts for our listeners before we move on to alternative investments?
When considering alternative investments, approach them with a cautious and informed mindset. Conduct thorough research, seek professional advice when needed, and ensure alignment with your overall investment goals and risk tolerance.
Excellent advice. Alternative investments can offer intriguing opportunities, but they also come with complexities that require careful consideration. Let's move on to our next topic, risk management, which is crucial no matter what your investment strategy is.
Risk management is indeed crucial in investing. It involves identifying, assessing, and mitigating potential risks that could adversely affect your investment portfolio.
What are some of the risks that investors should be aware of?
One primary risk is market risk, the potential for losses due to overall market fluctuations. Even if individual investments are sound, a broad market downturn can still impact your portfolio. Interest rate risk affects bond investments. When interest rates rise, bond prices tend to fall. Credit risk refers to the risk of a borrower defaulting on debt obligations, impacting the value of bonds or loans. Inflation risk erodes the purchasing power of investments over time. If inflation outpaces investment returns, real returns diminish. Liquidity risk is the risk of not being able to sell an investment quickly or at a fair price. Concentration risk arises when a significant portion of your portfolio is invested in a single asset sector or geographic region.
So how do we actually go about managing those risks?
Diversification, as previously discussed, is one of the most effective risk management strategies. It spreads risk, reducing the impact of any single investment's performance on your overall portfolio.
Aside from diversification, what are some other techniques investors can use?
Another important technique is asset allocation, strategically allocating your investments across different asset classes such as stocks, bonds, and cash. The optimal asset allocation for each investor depends on their individual circumstances, including investment goals, risk tolerance, and time horizon.
You mentioned time horizon. Can you elaborate on why that's so important in risk management?
A younger investor with a longer time horizon might allocate a larger portion to growth-oriented assets, like stocks having more time to recover from potential market downturns. An investor approaching retirement might favor a more conservative asset allocation with a higher proportion of bonds preserving capital and generating income.
Are there other risk management tools we haven't touched upon?
Setting stop-loss orders can help limit losses on individual investments. A stop-loss order is an instruction to sell a security when it reaches a certain price, preventing further losses if the price declines.
It's like a safety net to limit potential downside. What about hedging?
Hedging is another tool involving taking an offsetting position in a related asset to reduce potential losses. For example, an investor owning a portfolio of stocks might put options on the stock market index as a hedge.
Hedging can get pretty complex though, can't it?
Hedging can be complex, requiring an understanding of the associated costs and potential risks before implementation.
Any final thoughts on risk management before we move on?
Remember that risk is an inherent part of investing, but it can be managed effectively. Understanding the different types of risks, implementing appropriate risk management strategies, strategies and seeking professional guidance when needed can allow investors to navigate financial markets with greater confidence.
So we've talked about market cycles and how to manage risk within those cycles. What are some key takeaways for our listeners regarding market cycles?
Market cycles are inevitable. Do not let fear or greed dictate your investment decisions. Maintain a long-term perspective, stay disciplined, and remain focused on your investment goals.
You've mentioned emotional intelligence a few times today. Why is that so important in investing?
EQ encompasses recognizing, understanding, and managing emotions effectively. In investing, this translates to maintaining a rational and disciplined approach, even during market swings that can trigger fear or greed.
So it's about not letting your emotions get the best of you and make impulsive decisions. How can investors develop and improve their emotional intelligence?
Self-awareness is crucial. It involves understanding your own emotional triggers and how they might influence your investment decisions. For example, if you tend to panic during market downturns, having a predefined investment plan can help you stay disciplined.
Having that plan in place beforehand can prevent you from making rash decisions in the heat of the moment. What else can investors do to improve their emotional intelligence?
Another important aspect is controlling impulsive behavior. This might involve taking a step back from the market when emotions are intense or seeking advice from a trusted financial advisor.
So having those checks and balances in place can help prevent those emotional decisions. Are there any other tips for improving emotional intelligence?
Developing empathy enhances your emotional intelligence as an investor. Empathy involves understanding the perspectives and emotions of others, including fellow investors and market participants. Recognizing that market sentiment stems from collective emotions allows you to navigate investing's psychological aspects effectively.
So it's not just about the numbers, it's about understanding the human element as well. Any final thoughts on how investors can build their emotional intelligence?
Investing represents a journey requiring patience, discipline, and a willingness to learn from your experiences. Developing self-awareness, controlling impulsive behavior, and cultivating empathy strengthens your emotional intelligence as an investor.
Shifting gears to our final topic, let's talk about the principles of long-term investing. You've talked about having a long-term perspective throughout this conversation. Why is that mindset so important?
Financial markets inherently exhibit short-term volatility. Prices can fluctuate significantly daily or even hourly. However, over extended periods, markets tend to reflect the underlying growth and innovation of the global economy.
So don't get caught up in those day-to-day fluctuations. What's one way investors can put that long-term perspective into action?
Dollar cost averaging is one of the most effective methods for implementing a long-term investment strategy.
Can you remind us how dollar cost averaging works?
Dollar cost averaging involves investing a fixed sum at regular intervals irrespective of market conditions. Rather than attempting to time the market and invest a lump sum when prices are low, investing consistently enables you to acquire more shares when prices are low and fewer when prices are high, effectively reducing your average cost per share.
It takes the emotion out of investing and promotes consistency over time. What are some other principles long-term investors should keep in mind?
Patience is another vital principle. Long-term investing necessitates patience and a willingness to allow investments to grow over time. Do not become discouraged by short-term setbacks or tempted by quick profits.
Trust the process. Any final words of wisdom for our listeners as we wrap up our conversation today?
Investing is a personal endeavor. There is no universally applicable approach. What works for one investor may not work for another. Define your investment goals, assess your risk tolerance, and develop a strategy aligning with your individual circumstances.
Excellent advice. It's been a pleasure having you on the show today. You've shared a wealth of knowledge with our listeners.
Thank you for the opportunity to discuss these important topics.
Until next time, goodbye.